Good morning, everybody. This is Don Fall with Mercer Partners. We have just started to have everybody come into the webinar session for today. So we're going to give it just a minute for everybody to keep coming in, and then we will get started. All right, looks like we have most of everybody in, and we'll just let others as they join us in progress. We do want to get going because we have a lot of stuff we want to get to and leave plenty of time for conversation, discussion, questions, Q&A time, and all of that. So keep your questions handy. So good morning. This is I'm Don with Mercer Partners, and you've got the Mercer team here. Nick, senior partner and advisor, and Chad, partner and advisor. And we're delighted to have our time like this. For us, it's always a pleasure and a privilege to be together to share information for everybody's personal benefit, but also to add value to the conversations, the planning, the investment management that we do for everybody throughout the whole year. So for me, there's probably even a little more anticipation I have to be thrilled today that we're hearing from Dimensional Fund Advisors, who for me personally, I'm going to age myself, but I go back decades with history with dimensional funds. It's just a phenomenal group, and they have over the years multiple Nobel laureates involved with the organization, going back into the early 2000 and most recently is 2022. So we'll hear a little more about that in our speakers today from Nick. But real quick, a couple of Mercer updates before we launch into our discussion. One is you may notice in our backgrounds, we have a new logo, which behind that, we have a brand new website. Want to make sure everybody's aware of and check us out there. There's a little greater emphasis on the things that we value, and especially the education center at the site for moments like this. We're blogging more, talking more regularly, newsletters, these events, all part of what's there. Regular commentaries being posted for your benefit and or family members that you may want to share any of that with. So we're excited about that, and invite everybody to check that out a little bit more. And at the same time, we've had an expansion as we continue to serve more clients in broader regions. We now have an office physically in Montana, so we kind of have the Mountain States, Pacific Northwest covered, and from every office we cover those remote and virtual relationships coast to coast that we do have. So and some of you are with us today, so delighted to have that. So again, welcome. I'm going to turn it over to Nick to get us rolling with a little more about Dimensional and a little bit of housekeeping for getting through our time today. But thank you for joining us, and we look forward to our time ahead.
Thanks, Don. I echo your sentiment. We're super excited and happy to have our friends from Dimensional with us today. But before I turn it over to them to go through the bulk of today's presentation, just a few quick housekeeping items that I want to quickly go over. This presentation is being recorded. That should be noted. It is being recorded. Because of that, we have to disable the chat feature. So the chat is not accessible, but we absolutely want to hear from you. This presentation is designed to be interactive, right? We want questions. That's what we're doing this for, is to hear from you and to, hear what's on your mind. And, we've got experts with us today that are happy and willing to answer all of your questions. So the Q&A feature is absolutely functional. So if you have questions, either use the Q&A or type your, or raise your hand, and we can unmute you and you can ask your question verbally. So those are the two options to participate today: Q&A or raise your hand. So just want to make sure everyone's aware of that. It's important that we get that out for compliance purposes. But without any further ado, I'm going to introduce Dustin Weil. Dustin is a representative of Dimensional. He's a vice president, I believe, and a great partner of ours. And we're truly excited to have him and some of the outstanding talent that's at Dimensional join us today. As Don said, our history with Dimensional Funds as a firm goes back decades. Don being the champion of that, so we're really excited to have our friends at Dimensional with us today. So Dustin, I'm going to turn it over to you, and you can run from there.
Awesome. We'll get started then. Thank you so much for the opportunity to interact with you all today. We feel very, very fortunate to have the chance to work with Nick, Don, Chad, and the amazing clients that they all serve. We know that the assets, the money that you have invested with Mercer Partners represents decades of hard work and sacrifice on your part. And so we take the privilege of managing those assets very seriously. So thank you all for working with Mercer Partners, who's a great, partner of Dimensionals. I'm just going to quickly introduce my colleague because we have a fantastic speaker with us today. Rob Harvey is a good friend of mine, as well as a great resource from Dimensional. So Rob Harvey, a little bit of background on him about our speaker. He has his undergraduate degree from Villanova. He then got his master's in business administration from Cal Berkeley, and also is a CFA charter holder. So very impressive educational background. He's been at Dimensional now for over 8 years. So he has a wealth of experience from his career at Dimensional, both starting on the portfolio management side. So actually having experience managing various portfolios that Mercer Partners leverages for their clients. And now he's the co-head of our product specialist team. So couldn't think of a better person to bring onto our discussion today because his breadth of experience across Dimensional, both from working with advisors directly and their clients, as well as managing the portfolios himself, he's just a really, really great resource, which I think you'll hear from his comments today. So what I want to go ahead and do is kick it over to Rob. Rob's going to go through kind of an overview of what we've seen in markets recently, and then some of the key themes that we're getting questions around from advisors and their clients. And as Nick said, any and all questions are welcome throughout the session. So please raise your hand or use the Q&A function, and we're happy to take any questions throughout the conversation as we go. But with that, I'll hand it over to Rob so we can get started.
Great. Thank you, Dustin. And thanks to all of you for taking time out of your busy days to join us for the webcast. We've got a lot of really interesting things to talk about. I am fascinated to hear your opinions on it as we go through and share some of the thought leadership that we've put into building this agenda. And there's a lot to talk about, right? That we're going to start off, as Dustin said, reviewing what happened in markets over the course of the last year. So we'll talk about U.S. international markets. We'll talk about fixed income as well. And then something that's important, especially at the beginning of a new year, is to think back 12 months and really reflect on what did we think was going to happen over the course of last year? What were people talking about? What were they concerned about? How did that shake out in markets? So, let's give ourselves a scorecard for how we did in forecasting what this year was going to look like. Speaking of forecasting, we'll talk a little bit about politics after that, particularly U.S. politics. So lots, obviously, in the news now and has been for a long time about the control of Congress or the presidential election. What does that mean? Tariffs, obviously, coming up a lot now. So we'll get into some of those details. And since in the first couple bullets we talked about money and then we talked about politics, you'd think after that we might talk about someone's weight, but we're actually going to talk about something more controversial, which is diversification. And that is that not every dollar of an investor's allocation should go into the U.S. There's other opportunities out there. We're going to talk about what those are and why we think it's important to have some international diversification in a portfolio, sort of the case, for looking outside of just the U.S. So as we said before, questions anytime, but, if you see something in particular, get started thinking about those now. Let's talk about what happened in markets over the course of last year. And, you look at the performance of various markets, even on the equity side, phenomenal year, really, for U.S. markets overall. You had global equity markets up over 16% here, That's a great result overall. You usually think about the equity market premium delivering you something like 10%, 9, 10% in a year. So 16%, obviously a fantastic result that we saw, especially off of the back of a strong 2023, because remember, 2023 again was a positive double-digit year. Who did the most of the lifting in terms of who we have to thank for the 16% here? Well, converse to what I had just said about the importance of international diversification, at least on the surface, the U.S. was really the big winner here, right? It was 23% up in U.S. markets, which did much, much better than what you saw in developed markets, which were positive, obviously, not quite the same as what you saw in the U.S., but, at least you had positive returns there, and emerging markets, which were up 7%. We've heard a lot about people lamenting the performance of emerging markets, and certainly 7% is well below what the U.S. had managed to put up over this period of time. But also, just thinking about in a normal course of business, a 7% year isn't a terrible year to have. So at least positive figures that we saw across the board here. But obviously, as I said, U.S. is really the one that was leading the way, leading the charge in terms of that. We'll get into a little bit more of what that looked like in the U.S. market in just a bit. Fixed income, obviously a lot of focus on central bank activities. What's going to happen with interest rates? What does the yield curve look like? Is it going to normalize? Is it going to steepen? Well, we did see central banks continuing, actually even into, just this morning, thinking about cutting rates over the course of the year. And you did see that, you had positive returns in bonds, which is obviously fantastic. So, you got positive 3.4% in the global ag. U.S. here, though, trailed the rest of the world. We didn't quite get as many cuts as we thought we were going to get, at least at the beginning of the year. We'll talk about that in a minute. But you did have positive returns in fixed income, which is great to see. Globally, you saw better results there. A lot of that's being driven by the ECB, for example. You had economic growth being a little bit more sluggish over there, but inflation really seemed like it was under control over the course of last year in Europe. So they were able to cut a little bit more liberally, and you had some positive returns in global fixed income markets as well. U.S. did contribute to that a bit, but a little bit of a reversal of what we saw on the equity side. All right. That's what happened overall, but we also want to talk about what did we think was going to happen? So what were people talking about at this time last year? Did we think that the U.S. market was going to be up 23%? And I think this is very intuitive for most aspects of our life. You perform a certain way in your job, you get a review. Your kids come home with their grades, you look at their scorecards, right? You want to see. We need to do that for market forecasters and say, how are forecasters doing in terms of predicting what's going to happen in markets? It turns out they need a tutor because they didn't do very well over the course of last year. When you look at the beginning of 2023, what people thought was going to happen, they really missed the mark in terms of a strong year. So let's focus right now on the far right-hand side of this slide. We're just looking at 2024. So at the very end of 2023, 2024, what were people talking about? So these are where these estimates are taken from, not midway throughout the year. At the beginning of the year, what did they think the S&P 500 was going to do? So you have sort of a box and whiskers here. You've got your median analyst estimate right here. You've got your lowest point all the way down in red. And then you've got your optimists who live up here, right, all the way at the top end of the chart. And what's interesting is that even the most optimistic projection that we saw from analysts last year was about 10%. It was a little bit less than that, right? Because I think most people probably saw how phenomenal the actual return of equity markets was in 2023, right? You had a fantastic year in 2023, and they said, all right, well, the party's probably over, right? And it's probably time to pull back a little bit and expect things to go back down to earth. What happened? Well, really, it was pretty similar one year to the next. You had very, very similar double-digit returns, well over 20% in the S&P 500, which was a phenomenal result. And I think this is illustrative of a couple of different things here. And I want to kind of point out a few points in this chart that I think are particularly salient. First of all, when you look across the years, dating back from 2020, moving all the way to 2024, you have the people that I'm going to call your doomsayers, right? They're always going to be talking about how this is the year where everything's going to tank and it's all going to hell and it's time to get into cash. And sometimes those people are right? You saw 2022 The doomsayer for that was the closest, although they still got it wrong in terms of the impact. But right, a broken clock is right twice a day. You know, if you're a doomsayer, you're going to be wrong most of the time. The times that you're right, maybe Michael Lewis writes a book about you, right? So there's some incentive there, I think, to really set yourself as an outlier. But if you take these people seriously, at least the people who are always going to be negative, your perma bears, for example, they're never saying that the equity market is good, right? 2021, they managed to squeak above. I think the worst projection there was just about 1%. And you had close to a 30% return in 2021. So it's important to note you're always going to have people out there in the market who are saying that it's time to move out of the market. Doesn't mean that they're always right. So if there's any news stories about that, they're doing that on purpose. They're getting attention. Again, broken clock, right twice a day. Now, let's talk about some of the other interesting points about here. The median, right? Because you kind of think about the wisdom of crowds. If we all put forward our projections of what the S&P is going to be, then maybe together we know more than what we do individually. Sort of that jelly bean argument where one person can't guess how many jelly beans are in the jar, but everybody together does a good job. Again, not that great of a job. And here you see it's better, obviously, than what you saw from sort of the worst performers here. But overall, the equity market is, you know, projected to be pretty tame over time, even below what we generally expect to see for the equity premium. You know, like I talked about before, 10% is a reasonable expectation to have for an equity market. And in fact, we show here the historical average for the S&P 500 is 12.5%. So you'd kind of expect that the median wind up around that area. And yet even then, you kind of have people falling quite a bit below that. Nick, anything from you before I move on here?
Well, what really stands out to me, Rob, and you know, maybe you can talk a little bit more about this, but what I see is looking back over the last 5 years, you get these really big chunks, really big gains some years, and then you know, you have 2022 where you have a really down year. But very rarely do you actually get the return of the market, right? Around that 10 to 12% return. You get these big chunk years, and then you have these big down years, but then it'll average out to somewhere around, you know, 10 to 12%. So the distribution of returns, I guess is the technical term, you know, tends to be very wide. So, you know, maybe some kind of thoughts about how, you know, the markets actually behave and maybe what investors can take away from, you know, from the way that markets really work.
Yeah, Nick, you're so right. And I think this is important for equity investors to understand, which is you look at the long-term equity performance of 10%, maybe here 12%. And you kind of almost in some ways think about like clipping the coupon for a bond, right? You show up to the market, you get your 10% and you go home happy. And actually, Nick, what you're pointing out is that's not the experience at all. And in fact, it almost never is. I'm going to show you that in just one slide here. But this is one of the, I think, difficulties of being an equity market investor is if you think about it, if bonds always outperform, if bonds always put up, let's say 2% nominally for forever, and equities did 8 to 10% forever, flat, you know, there was no variability. Why would anyone invest in bonds? Like you, of course you would always invest in equities, right? Because there is no downside. You're just getting that 10% year over year over year. Obviously, that's not what happened. The reason that you invest in bonds is so that you can avoid some of the 2022. Ironically, of course, fixed income didn't do well in that year either. But that's sort of the idea, right? You're buffering some of that downside. But it just doesn't happen that often that you get that exact 12%. And, you know, as I said before, you can look at what equity markets have delivered historically. Nick, exactly to your point, how often do they hit that 12% return? And here we're saying, look, you don't even have to hit 12% for us to call you good enough, like you're in line. We'll give you 5% on one end of that or the other. So anywhere from 17% to 7%. Okay. And we're going to call that you hit, you're close enough. And even then, you barely ever see that happen, right? The swings that you have in the equity market are massively up. Sometimes they're massively down too. That's part of the experience. So when advisors like you all think about engaging with clients, when you assess what is your appetite for risk, you know, what do you think? Can you stomach a year down of 20% or 30%? You have to be able to do that to be an equity investor, because that will absolutely happen. There's very little smooth sailing that happens in equity markets over the long term, although I'll show you the advantage of sticking with it in just a second. But anyway, Nick, I think that's an important point to make there.
Yeah, absolutely. I mean, I think we tell our clients all the time that on any given year, on average, the market's going to be down at some point, 10 to 15%, somewhere around there. That's, just looking at the long-term historical trends. And every 5 years, the market's down, right? 25, 30% potentially, right? That's the nature of the markets, but over time, the markets trend higher, right? And you're rewarded as an equity investor with an equity premium, right? That above the risk-free rate, right? That's been very handsome and very rewarding for people that can stick with, the volatility that we see in the market. So I think it's just an excellent, Rob, that, we definitely want to be driving home and reiterating, as much as possible.
Yeah, and Nick, you used the term reward there a few times, and I love that, because when you look at a chart like this one and you focus in on some of these really bad periods of time here, which we all remember, right? Great financial crisis, you got 2022, and sort of the COVID blip that you've gotten here as well. What do you get for having sat through that as an equity investors? Well, you've got everything that's way above this line, right? So that's your reward. The price of the ticket to ride to earn the equity premium is you got to stick through some of these down periods. And unfortunately, we really don't know when they're going to happen. And you can see that based off of how poorly forecasts are at doing and predicting the future, right? Which is, if people really had a good understanding when it was time to move out of equity markets and into fixed income or cash, they would do it. But you just don't see that happen. You don't see it happen by the forecasters, and you also don't see it by the performance of active managers, in the sense of like traditional stock picking active managers who have macro bets. They don't tend to do very well versus their passive benchmarks, which are just constantly invested in the market over time. And a lot of that is because they too struggle, even when they're putting their money where their mouth is, to outperform markets over time and try to guess when the up's going to happen versus the down. All right, let's talk about some maybe positive spin on this too, which is, obviously it has been positive over the last year, but what is sort of that experience been like as an investor for the growth of wealth? And I think one thing that's interesting to consider is, if you had told forecasters at the beginning of the last year not how the market would do, but instead you described what the major news stories of this year would have been, do you think that they would have done any better? And let's take a look at what some of the news stories are and kind of remind ourselves what people were talking about. At the beginning of last year, the market was pricing in 7 cuts by the Fed throughout the entire year. So there was a lot of hype and expectations that rates were going to go a lot lower to help stimulate the economy because inflation would be under control, right? Turns out inflation was quite a bit stickier than we had originally thought, and we only got 3 cuts. So let's say you're telling a forecaster, hey, you need to update your models, and instead of 7 cuts, you need to bring it down to 3. And on top of that, there's going to be a couple of macro events you need to be aware of. Conflict in Gaza still going on. Conflict in Ukraine still going on. There's going to be a lot of political events that happen, throughout the course of the year. We focus a lot, obviously, here on the U.S. election, but let's not forget, Canadian government fell apart at the end of the year. Martial law imposed in South Korea at the end of the year. There's a lot of major geopolitical attentions that are happening here. And on the economic side, when you talk about inflation not being licked, that is important, right? People were really expecting to get some relief in terms of lower interest rates. Didn't happen either. Now, I'm willing to bet that if you told most forecasters all of those events throughout the course of last year, they're probably going to tell you that it's a good time to set on the markets, right? They're going to revise it even lower. And yet again, you saw that it was a phenomenal year. And you kind of see this going back in time as well. And that's what this chart is doing, is think about how scary in the moment Y2K was. And not everybody here is old enough to remember Y2K. I remember. I highly doubt Dustin was, but I'll have to check him on that later. But, I remember my dad was working at a technology company at the time, and they just didn't know if the computers would even turn on the next day. They weren't sure about that. So it sounds stupid now, and you look back and you think, that wasn't that big of a deal. But in the moment it was. And then you've got some real serious events in here, right? Like the COVID pandemic and Brexit, the subprime mortgage, crisis that we have. But throughout it all, and I think this is really what Nick was hitting on here, is you stayed invested through 1970. And if you look at the growth of wealth that's happened over time, these major events that really were major in the time that they were going on kind of feel like blips on the radar almost. You just don't really see that massive correction and the inability to make up the lost ground there in any given period. If you have a longer term perspective, which is what we advocate for if you're an equity investor, then you're able to sort of look at the bigger picture and say, equity markets have been good to me. I'm okay sitting through little periods of time where you've got, down markets for a brief period, because your lifespan of an investor should be decades if you're invested in equities, and they tend to bounce back. So important here. Also, one of the things that, we talk about a lot here at Dimensional is the importance of having an advisor in your life to make sure that you can help weather the storm, because there's a lot of media out there that's trying to distract you or get you to pay attention to very particular micro events in the market. There's all these commercials on Bloomberg and CNBC about trade your account, get in there, take action. And really all of this is just meant to distract investors, because your broker's not making any money if you stay invested long term, but you are. And I think that's really where the power of the advisor comes in to say, I know this is tough to sit through this, but it's our belief here at Dimensional that the right plan for your clients is the one that you draw up from them, not the one that they hear, when they're watching CNBC. Nick, did you have anything on that?
Yeah, and I think your points are spot on, Rob. I mean, I look at a chart like this, and the phrase that we often use here at Mercer Partners when counseling our clients in terms of their investments is, it's simple but not easy, right? Because it looks so easy. All you got to do is just invest and hold on, right? But it's not an easy thing to do, right? Particularly when you have all of these events, all of the the apocalypse du jour of the day, as I like to call it sometimes, right? And obviously the CNBCs of the world are sometimes working against you, because their incentive is to sell advertisements and to get eyeballs. So obviously, they want to create some sense of urgency and panic. It gets more people to tune in so they can sell more ads. But ultimately, if you just buy great investments and you hold them over time, you're going to be rewarded, right? And and that's the Dimensional way. That's the Mercer Partners way. And I think there's a lot of value to that. So simple but not easy. That's what I think of when I always see this chart.
Yeah, the last
completely
point
agree. Dustin?
I would just highlight here is there's always going to be reasons over the long-term chart we see them, as well as year over year. There's always going to be events that cause concern for investors, but that's why we work with great advisors like Nick, Don, and Chad. They put us in thoughtful portfolios that are diversified across the global markets, have a mix of equity and fixed income and other assets, so that we can weather these storms. We get compensated as investors for uncertainty and for staying in our investments through these different events that happen. And so we should expect in any year, as Nick said, to have a 5-10% drawdown. That's very common to have in any year. So we should expect events to occur. The most important thing is we know as investors, we can't anticipate what these events are going to be beforehand and what their impact is going to be on the market. So our best course of action is to have a thoughtful portfolio like the one that Mercer Partners puts together, and to make sure we stick with them through the ups and the downs. So that's the point that I would add here.
Yeah, absolutely correct. And the good news is, when we're working with, Dimensional here, for example, you're not alone, because we have a lot of content that we put out to make sure that you can help navigate those difficult conversations with your clients. Stuff like, for example, what you see on the next slide here, which is when you think about being in the recession and what the returns look like. Obviously, once you've taken the hit, you've taken the hit. Where do you go from there? How do you position your money going forward? And these are just interesting studies that we publish that, really help illuminate the power of staying invested, which is look at what you're getting 1 year, after a recession has occurred versus just staying around for the next 5 years. And what do your returns look like? And that massive difference there. So, when you get concerned calls from investors, and you will, obviously, and you know that better than anybody, just remember that there's a lot of resources out there to help you navigate that. Dimensional has quite a bit of thought that's been put into these, and obviously we've got tons more slides than we could even share with you today. One other thing that I'll point out here, and I think this is kind of a different way of thinking it, is you hear a lot about dry powder out there and sitting on the sidelines, and it feels very harmless in some ways, right? I'm just going to wait and see how things shake out. Let's just see how this major event unfolds before I get back into the market. That's something that I hear a lot. And when we look at the total growth of wealth, going back not even that long ago, it's going back to 1997 here, missing even just a couple of days in the market, if they're the wrong couple of days, is pretty painful, right? When you if you stay about invested the entire time, since 97, you grew $1,000 into $10,000, which is a phenomenal period of growth that we've experienced, even though it's been a difficult period in the U.S. largely. There's the lost decade that occurred in there, as well as, some phenomenal years too. But not only is it important to note that you missed the best week and you cut a huge amount of your wealth out of that, right? You've just shaved off $2,000 off of the close to $10,000 that you made just for a week. But also, what's important in that is note which week that is. It's November 2008. It doesn't get much scarier than November 2008. That was a horrifying period of time where people weren't sure what was going to be happening, right? Did markets completely collapse? Was that Citibank that you held your cash account at going to be around tomorrow? Was it going to be shuttered, right? That was a scary event. Same thing with the worst month, for example. Look at April 2022 of 2020. Back then in 2020, we were bleaching our groceries. We were filling up Ziploc bags full of gasoline, right? There was a run on toilet paper. It was a wild period of time where we didn't know if we were going to be around tomorrow. And then you miss out on that month. And again, massive cut in the wealth. So I think it's important to note missing a few days can be impactful. And it turns out that the days that you miss that are the most impactful are the days where the temptation is the biggest, right, to miss them. And you see, obviously, a couple of major events here that are driving that. So that was markets. Nick, Chad, Don, any thoughts on that before we move on to our politics section?
Yeah, I mean, I think what you're really highlighting here, Rob, is, it's impossible to time the market, right? To get in at exactly the right time, to get out at the right time. At Mercer Partners, obviously, we do not engage in any type of market timing. If that's what you're looking from us, then you're in the wrong place, because we don't know how to do that. And we don't know anyone who can do that, successfully, consistently over time. I mean, I think this chart just really goes to highlight that. So, yeah. So that's kind of my thoughts.
All right, well, let's
stay invested. And, but the best days and the worst days tend to be clustered together. I think, that's
they
what
do. Yeah,
that's what
they do. And you even saw
it so hard.
I mean, you kind of saw it on this graph too. That sharp drop down follows by, a pretty sharp increase up. So I think some of this stuff is exactly like you said. There's a bounce back, and sort of a microcosm. We've seen a little bit of that this week already, right? We had DeepSeek on Monday completely tank markets because everybody thought the Chinese AI was just going to be running over NVIDIA. And then the rest of the week turned out to actually be pretty good. So, there's sort of tends to be some overreactions in markets one way or another. So if you get caught up in that, I think it can be difficult. But anyway, I don't see anything in the poll. I just wanted to make sure if you guys are seeing anything in terms of the poll, or anybody raise their hand. Otherwise, we can move on to another juicy topic in politics.
Yeah, let's go to politics. But yeah, as a friendly reminder, everybody, joining us, if you have any questions for Rob or anyone on the panel, please use that Q&A feature, or go ahead and raise your hand. We're monitoring that closely. Would love to hear from you. So, but go ahead,
sounds good.
Rob. I know politics is a hot topic. Love to get your thoughts on it.
Yeah, well, if market movements didn't provoke you, we're going to try to do it with politics. So we'll see where we can go with that one. But actually, when you think about our perspective on markets, our perspective on politics isn't going to be that surprising to you. And again, at Dimensional, we want to just sort of not make speculation about what's going to happen in the future, or extrapolate some events that have happened in the past and say, oh, well, surely this is what's going to happen next. Let's look at the historical data, first of all, and see what's happened. Because I think, particularly in vicious elections, which is, I would say, probably fair to say is what's happened recently. A lot of you get sort of tone from both sides, which is, if that guy wins, it's all over, right? Or if that woman wins, it's the end of Earth as we know it. And so you kind of have these dramatic statements made by both sides that make it feel like if you're on that other side and you lose, it's over, right? And you got to pull out. Or if you win, time to go all in. And I think really when you look at it again through the perspective of a growth of wealth, there's a few things that we have to recognize. One of the things is, we don't have a lot of data points on presidential elections and how the market moves because of that. You have roughly 16 observations here through different presidential cycles dating all the way back to 1926. That is not a lot of observations. If you want to be confident about something like how often does an equity market outperform bonds, for example, you can look at daily returns going back close to 100 years. And even then, the odds of a daily equity premium versus fixed income are less than 70%. So it's very noisy, right? That data that you see, even if you have a tremendous amount of observations. Here we have about 16. And what's interesting too about each one of these observations is there's a tremendous amount going on, right? Not just with the administration, but what's inflation doing? What does the geopolitical format look like? What are rates at? And so there's just a lot there, I think, that's also important to unpack. But we see a lot of partisan talk coming out of both parties, especially leading up to an election, that I think can be dangerous for investors to really internalize, at least with the way that they invest their money. And what you can see here is that it tends to be the case that whether you're invested with a Republican administration or a Democratic administration, you did really well. So unfortunately, for both sides, who I'm sure would love to paint a different picture, it turns out that both are perfectly fine for good returns. We're kind of going to forgive poor Hoover back here, because I think being a Republican back then meant something different than what it is today. But even so, it was in the Great Depression, and I can't really blame President Hoover for that. So aside from that, you had pretty good years throughout most administrations, and that's important to keep in mind. Now, obviously, when you look at something like this, you are tempted to say, okay, but that's the presidents. The presidents don't control everything, though. We also need to look at Congress. And when you look at the performance of Congress, it's kind of the same thing. It doesn't help clarify the picture, right? There's lots of times where it's mixed, especially more recently, but control of Congress, again, doesn't seem to dictate one thing versus another in terms of what you can expect to have happen in the market. And there's something that important that I want to talk about here too when we discuss politics and sort of a forward-looking perspective on what happens with markets. Wind the clocks back a couple months here and think about early November, before we know the results of the election. I don't care who you were, everybody was dreading Thanksgiving dinner, because you knew that you'd have relatives who were at Thanksgiving that was going to talk about one side, and they were going to get in the face of the person who's going to talk about the other side, right? We knew even before the election, or even any idea of what the election results were, everybody was going to on everybody's mind about the problems we were going to have, just at a personal level from the election. When you're thinking about that, it's hard to then make the jump that the rest of the market isn't pricing in an outcome or the weighted average of outcomes of individual investors, right? If you think Trump is going to win and Trump is good for markets, you're going to place that bet in the market. If you think Trump is going to win and he's bad for the markets, you're going to place that bet, right? So I think when you try to forecast going forward, oh, this party will do this or that party do that, part of what you have to think about is that information a secret? Do I think I know something that nobody else knows? Because if you're digesting something from the news, by definition, you don't know something that everybody else doesn't know, right? You all know the same thing. It's been announced on Fox or CNBC or whatever it is. So I think that's important to keep in mind, that even if you have a perspective and it's an informed perspective, you have to always think about what stops other people from knowing this. Is this incorporated into market prices? And I think historically, we just haven't seen, again, that there's a good way to guess, I think this person's going to win and therefore this is what's going to happen in markets, other than markets tend to do well over time. Nick, did you have something there?
Yeah, I mean, I think these charts, speak for themselves in terms of the, how, kind of staying, not mixing, investing in politics is obviously
Yeah.
the right way to think about things. But, and I don't think, other than, with Trump obviously being elected, I think that, just kind of common sense, if there is deregulation and potentially more favorable tax policy, I can't see how that, or particularly corporate taxes, I can't see how that wouldn't necessarily be helpful for corporate earnings. But kind of regardless of who's in office, this is one thing that we constantly tell our clients when we get questions around politics, because obviously this is something that comes up and it's, something people are thinking about. But, regardless of who's in office or what is going on with, policy in Washington, the board of directors and C-suite folks at Apple or Google or Home Depot or, Nike, Adobe, regardless of whoever's in office, they're going to make, business decisions and, adjust course accordingly to make sure that profits continue to roll in, right? And corporate earnings
Yep.
remain strong. So, I think regardless of what's going on in Washington, the beauty of free market capitalism is, is always going to reign supreme. At least that's kind of the way we think about it, when, having these discussions with clients is, if there's ever an assault on capitalism, then that kind of changes things. But as long as that remains intact, I think from an investing standpoint, markets are always going to go up.
Yeah, agree.
Yeah.
Dustin, Don, saw you guys both unmute.
Yeah, the point I would just quickly make is when we're investing in companies and not in
Right.
political parties. And just as Nick said, these companies are going to look at the situation regardless of who is in power in Washington, say, how can we make sure that we are putting our company in the best stance to earn money for our shareholders, regardless of who is in power. And so think about it that way. We're investing in the continued ingenuity of entrepreneurs and companies within the US, and we're not tying ourselves to political parties. And we can see this in the chart here, as well as the last chart that showed all the different presidents in power and the growth of a dollar throughout this entire history, to show if you're able to put the blinders on and not let politics cloud your judgment in investing, you can have a really great investment experience.
Yeah. Yep. Don?
So not to derail this, but yeah, I'm glad you jumped back to this slide. So for grains, for trivia, we have everybody that's attending today, we have a wide range of age groups, but you look back to the Roosevelt era, he was the last of the more than two-term presidents. He was elected and then reelected 4 different times. So that's why that particular band goes a little bit longer, but we've been hearing about that second, that two-term presidency lately, but he was the
Yeah,
last.
we have. That's true. That's true.
Yeah.
Yeah. One thing that I think that resonates with me, and we've seen this a lot in the post-financial crisis world, which is regulators will make, sort of try to change an industry or try to, regulate or control something or stop something from happening. And private enterprise finds a way to be successful, like Nick was saying. And I think that's really important, that's kind of what you hope, right? No matter who you're rooting for in terms of which party, we're all rooting for capitalism. And that is that companies find a way to be successful if they can be. And one of the things that we've heard a lot about recently is tariffs. So I'll share a slide on tariffs in just a second. But one of the things that you saw with tariffs is you had a lot of goods being pushed immediately before Trump went into office out of fear of tariffs, which is a great way for companies to make sure they're not paying those tariffs, right? You can kind of change your supply chains quickly to make sure that you're accommodating and finding a way to still be effective. Now, obviously, there's still a lot of consternation about tariffs in general, but the good news is we've got some historical precedent of what's happened with tariffs and standoffs before, because we've been here before. This was Trump's, first time in office. Obviously, it was sort of less broad-based. Now we're talking about tariffs against a lot of different countries. But China was really in the focus. They were really in the focal point for the U.S. in terms of tariffs for the first administration. And there was a lot of tariffs that were implemented, actually. You could see here that you've got, retaliatory tariffs of up to 25% across a whole range of products through a major trading partner for the U.S. And again, when you look at the performance of the U.S. and China, who were really entangled specifically in this tariff war, they did much better than the rest of the developed world here. You were much better off investing in both of those countries. So if you had heard that rhetoric about tariffs, and even if you knew that they were coming for sure, which, by the way, we don't know, I think that still would have led you to the incorrect conclusion about which market really would have done best. And really, again, private enterprises found a way to succeed. Markets paid investors for sticking around for that.
So we did get a question, Rob, from Rick around tariffs. And so point blank, I mean, if the tariffs that are being proposed are implemented, what do you think is the impact to the U.S. markets?
Yeah. I mean, usually from what we've seen historically from studies that have been done, a lot of those tariffs do impact the consumers in the country who are implementing the tariffs. So meaning U.S. consumers end up bearing the brunt of tariffs that the U.S. is implementing on other countries. But it's hard to say from a graphic like this one that's going to have an impact on markets, right? And that's really what we're here for. Will tariffs impact your day-to-day life? It's very possible that they will, right? You could see sort of a change in spending habits, or even just a redirection in terms of products that you're buying. Now, all of a sudden, German cars look different in terms of their cost-benefit analysis to Chinese cars, for example. So there may be sort of shifts in that type of pattern. And I think one way to think about this is, when we talk about tariffs, when we talk about politics, I don't want to make the case that it doesn't matter. These issues absolutely do matter, and you need to pay attention to them, and they can affect your day-to-day life in various ways. And so you need to pay attention in the polls. You needed to pay attention with your wallet. The point here is, from a market perspective and what markets return, it actually turns out to not be that impactful. So will tariffs have an impact? I have no doubt that they will if they're implemented. But even then, and I mentioned this before, we kind of have to take a step back and say, how much of this is a bargaining chip that's being put down on a table? All right, like Trump is actively forcing countries to come and engage with us, on our terms, for whether or not you agree with that diplomatic approach or not, I don't know. But that's not a guarantee that they'll be implemented. And in fact, we've seen a lot of tariffs that were promised, those day one tariffs, haven't taken effect. So I would say not certain to happen. And even if they do happen, the impact on markets, at least, is inconclusive.
Yep. I think I totally agree with exactly what you're saying, Rob. I mean, I think, and look, I don't think any of us know for sure or have any inside baseball information, but it just seems to me as an outside observer that a lot of this is just negotiating tactics, right? To try to get, like you said, people to the table and get better favorable, trading terms for the U.S. And so we'll see what happens. But I think your point is well taken. And there's nothing we're doing in terms of our portfolio construction, in terms of our investment management decisions, regarding tariffs. We want to build, diversified, high quality, low cost portfolios, and that's continues to be the kind of guiding North Star in terms of how we want to, invest going forward, regardless of the tariff trepidation.
Yeah, and in my opinion, that's the right way to do it. You can control what you can control, which is, making sure that you're staying the course and thinking about it from an asset allocation. There isn't like a tariff safe portfolio that you can build, even if you were sure that they were coming. So, yeah. All right. Any other questions? Politics, tariffs. We're going to move on to, I think, what is also sometimes a controversial topic, which is why you should invest outside the U.S. But before we get there, I just want to make sure we didn't have anything else from anybody.
No questions coming in, so let's move to the next topic.
Great. Well, let's talk a little bit about international diversification here. And I think this one is a tough point to make, admittedly, given how well the U.S. has done this year and last year. Plus, on top of that, we know investors tend to have a home bias, and it doesn't matter where you are. This isn't just a U.S. phenomenon. We know, obviously, a lot of U.S. investors have a heavy U.S. home bias where maybe all of their investments are in the U.S. In Canada, that happens, and the Canadian market is much smaller. In the UK, that happens. In Australia, that happens. So people tend to invest in the things that they know and the things that they like, and that tends to be the companies that are right in your backyard, right? So not uncommon, but I do think it's important to note when you assess how big America is in terms of its impact on global capitalization, it's massive, by far the biggest, country out there. But it is still only 61% of global market capitalization coverage. So the rest of that is covered by other countries outside of the US. So if you had to give yourself a grade for having a US only portfolio, it should probably be a D- because you only got 61% of coverage. And it's not to say that you need to have every country in the world as part of your portfolio, but some allocation may help. Now, one of the arguments that we hear for having a U.S. focus in the portfolio is, well, they're global companies, right? So Coca-Cola operates all around the world. They have revenues in every country. So aren't I kind of getting international exposure through U.S. multinationals? And in some sense, that's true. But when you look at, and we'll show you this in a little bit of detail, when you look at how the U.S. has performed versus other markets outside the U.S., you don't see a very strong correlation there, right? And in fact, that's a good thing for international diversification. But if you did see the U.S. influenced or moving similarly to developed markets outside the U.S., then there'd be less of a case. But for diversification, since you're kind of getting a similar experience, that's not the case, though. So you actually do get a diversification benefit, and I'll talk about that in a little bit. But one of the things that we'll talk about, too, is there's a lot of companies that you know and love that are not part of the U.S. universe. And I think some of this is also important to keep in mind of which companies those are. So obviously there's quite a bit in terms of the S&P 500's market capitalization coverage, but there's a lot of companies that you don't have in the S&P 500, for example, that are even operating inside the U.S. So things like if you ever use Zoom, for example, like right now, Workday, KKR, there are major companies that are not part of the S&P 500, which a lot of people consider to be the U.S. market. But even once you extend into something more complete, like the Russell 3000 or a dimensional product that invests across the market capitalization spectrum, you're missing out on a lot of companies that have major impacts for U.S. consumers. We've listed out a few here, and these are obviously the largest companies, being sorted from top to bottom: Samsung, Toyota, AstraZeneca from the UK, Shell. You've got all kinds of tech and energy and materials and industrials that have a big influence on the U.S. consumer, major players in the market that you're kind of ignoring if you don't have sort of that extra addition of that international exposure. You just look at the name count alone, in the MSCI ACWI IMI, you've got close to 9,000 companies, which is a lot. Obviously, in the U.S., if you're invested in the Russell 3000, you have about 3,000. But in a dimensional portfolio, you've got over 12,000 names in there because we have a lot of microcap names that you just don't have in even the ACWI IMI. So when you think about it from the perspective of what's the count of names that you're missing out on, it's massive on what you're not getting if you only be a U.S. investor. Now, obviously, that's kind of cold comfort for some people because they're like, yes, but the performance has been so good. One of the things that we have to think about when we talk about performance is what's driving it. What are the companies that are really moving the needle in the U.S.? And what we're seeing in the U.S. is a very concentrated group of securities that are moving the market substantially, which is Mag 7, Fan Mag, Batman, whatever we're calling it today. It's the top names in the U.S. that are influencing the majority of the returns. So last year, for example, you saw the U.S. market up 22 and odd %. Those top 7 names, we'll call them Mag 7, was up something like, I don't remember exactly the number, but I'm going to say it was about 44%. Okay, that's what the Mag 7 had delivered last year. What did everything outside the Mag 7 in the U.S. deliver? We'll get back to you on exactly what the numbers are, but I want to say it was about 6%. It was worse than, for example, emerging markets, the rest of the U.S. market. So you have sort of the haves and haves not in the US, a lot of your returns are being driven by the same names that we all know and love, your Amazons, your Nvidias, your Teslas, whatever. But they're becoming a much larger part of the US investment experience. So when you're invested in the S&P 500, for the first time in the history of the S&P 500, you now have over a third of your portfolio that's invested in the top 10 largest names in the US. So the concentration risk is going up a lot in the US. And when you have days like Monday, where all of a sudden people freak out and start worrying about NVIDIA, if your portfolio is a third of NVIDIA and the ilk, like Microsoft, then that is a particularly scary time for you. Whereas if you invested in the ACWI, it's still painful, but you're doing better than what you would have, right? And so we don't know when these periods of time are going to come, but very popular topic. Nick, I fully expect we're going to get questions on this one, so maybe a good time to open it up right now.
Yeah, definitely. Would love to hear from our audience in terms of their questions. I mean, I think obviously at Mercer Partners, our clients know this. I mean, we're big proponents of broad-based diversification, right? We want to be diversified across, different asset classes, different sectors, industries, geographies, as you're pointing out, Rob. We don't know exactly where the returns are going to come from year in, year out. That's why we want to be broadly diversified. So no matter where the best returns are, we're there to capture them, right? Big fans of capturing what the market has to offer. Now,
Yeah.
I will say that, we do have a home country bias in our portfolios, right? At Mercer Partners. Now, does that mean that we don't have international investments? No. We are broadly and globally diversified, but we do have what you would consider an overweight to the US, right? Because our take is that it is the most liquid, most dominant market segment in the world around the globe, right? So and that's obviously proven to be a good thing for investors. So I don't necessarily see that changing, but obviously it's important to note that we do own companies outside the U.S. border as well, and that won't change. That's a good thing to be invested. So
and by the way, like the point here isn't don't have a U.S. home bias, and even in our global portfolios, dimensional offers, we have a home bias because we recognize that's what people want. And like when I was in Canada last week talking to Canadian investors, my point here isn't you shouldn't have an overweight to Canada. My point here is you shouldn't be 50% Canada when it's 3% of market capitalization. So if you have any international diversification, you're doing much better than some U.S. investors, and I think that could come in handy. I'll talk about why in a little bit. So home bias, perfectly fine. Excluding everything else other than your country, you might want to think about that. So I think we're all pretty well aligned on that. I will say while we're waiting,
China was only 3%. That was kind of interesting of the global market.
Yes. So that is, let's go back to that here for a second. I think a lot of people, when they think about market capitalization, tie that to GDP, for example. But remember that a lot of Chinese enterprises are controlled by the government. They're not publicly listed securities either. So there's kind of a little bit of a disconnect there. In the U.S., it tends to be the case that, there's a stronger correlation there where heavily regulated economies like China is a little bit different. But it's a good point. It's worth pointing out, too. Because, it's interesting when we get concerns from investors, which have happened a lot over the last few years, about China in an internationally diversified portfolio. It's important to take a step back and say, listen, if you have a home bias and your market cap weighted outside the US, you have it's like negligible in China. It's something, right? 3% even on market cap weighted, but if you have a home bias, it's less. So important, but again, one of the benefits of diversification is you don't have to focus so much on what's happening in Malaysia because it's not that big of your portfolio, right?
So I got a couple questions for you on diversification, Rob. So obviously diversification is great. Where do you think that, and what's, your kind of thoughts and, dimensional broadly on a couple asset classes that we often get questions about, real estate being one, gold being another, do these asset classes belong in a portfolio potentially? I have my thoughts, but And then also, if you look at my inbox, the big wave now is around private investments, right? Private credit, private equity. You know, as a financial advisor, you know, I have asset management companies reaching out to me almost every day. You know,
I'm sure you do.
telling me about the new asset classes in terms of privates and how they can be implemented into client portfolios. Is this something, you know, I guess let me preface my question saying, like, where does the academic research on these asset classes stand? Because, you know, obviously we like to follow the science and the research. I mean, can they potentially have a role?
Yeah, let's talk about these. I'm going to add one to your list there. Let's add crypto to the list because I'll talk about things that take up space in my inbox. That's one of them. So the first one is REITs. So we'll talk about REITs first. So, you know, with REITs, one of the things that you have to think about as an investor is what does the after-tax return look like for an investment? With REITs, what's interesting is they're very tax inefficient. There's a lot of distributions that get thrown off of REITs. So REITs, in terms of exposure to the real estate market, perfectly acceptable. That is absolutely a role that can be played in someone's portfolio, depending on what their real estate exposure already is, of course, because I think that's an important consideration. But there's a tax impact here as well, which is, you know, we think a lot about the distributions and the tax efficiency of vehicles. If that's something that you care about, you have to be very careful with REITs. And so Dimensional's perspective isn't that REITs don't belong in a portfolio. Our perspective is you need to have the ability to customize and control your REITs exposure. And so at least at Dimensional, our research has pointed us towards have standard equity portfolios and then have REITs portfolios. And your equity portfolios don't have REITs, but your REITs are separate because it turns out that REITs perform very differently from the rest of the equity market, which you'd expect, right? When you buy REITs, you're anticipating getting real estate exposure. And that should be different from equity exposure, right? That's one of the benefits of diversification.
Would it be fair to say, and this is based on, you know, what I know about REITs, when looking at it in terms of the inclusion of our client portfolios, they tend to be more volatile than the stock market and historically have produced less return in terms of the publicly traded REITs. Is that a fair statement?
They have produced less than equity markets over time. The volatility is sort of time period dependent because overall you generally think about them, I don't want to say like a fixed income instrument, but they're more interest rate sensitive. So in an environment where interest rates are more stable, you tend to see REIT performance be more stable. Think about the last couple of years and how devastating that's been for REITs. That's because you've had a lot of changes with interest rates, right? You had interest rates going up. REITs got crushed. They're coming back down. REITs had a little bit of a comeback last year. Wasn't enough to keep up with the rest of the U.S. equity market, but so it's sort of time period dependent. And I actually think that's okay. Like even if the volatility of REITs is the same as the U.S. market, just the fact that it's performing differently does provide you a little bit of offset there. But you're absolutely right that REITs tend to trail the rest of the equity market over time by a bit. And again, that's kind of what you'd expect with the stability of the cash flows, looking a little bit more fixed income like than equity.
Right.
All right, let's talk about gold. And I heard a lot about gold, especially around the election, because people were saying, I'm nervous. I think I want to put some money in something safe. And, you know, I'm not getting a lot in my treasury investments, especially with rates being cut. So in the short end of the curve looking like what it was, which is obviously the US curve, you know, being inverted, any kind of duration just wasn't paying for you. So gold, maybe that's something to think about. And then the other thing I hear about gold is an inflation hedge. So I'll talk about those two things. When you look at the price of gold over the course of last year, it's up by a lot. Gold did really, really well last year, but gold did well presumably because it is noted as a safe haven asset. So if you're getting worried, if you're panicking a little bit in the market and you're thinking, ooh, maybe gold's a good place to put my money, it's important to look at where gold is at and where it's been, because if it's up a lot, it might be the case that one of the reasons that it's up is other people are also panicking and moving into gold. So you're buying gold higher. You are paying for the fact that someone is selling you that gold and getting into a either riskier asset or one that has a lower yield, for example. So one of the things that I think is important for investors is it's not just a free, protection for your wealth. It has a price, right? And there's actually an underlying value for gold, which we'll talk about in a second when I get to crypto. And that's, if you don't understand where that should be, if you don't have a viewpoint on what gold is actually doing for you, it probably doesn't belong in your portfolio. The other thing that I hear a lot about gold is it's an inflation hedge, and that's a good thing. One of the things I think is interesting to do is plot how inflation moves versus how gold moves. Gold is a very volatile asset. So if you have inflation that I'm just going to show you in a graph, maybe it looks like this, and your hedge for inflation is an asset that's doing this, that's not a good hedge, right? You want something that moves opposite to what you're trying to offset in order to be a hedge. And gold is very volatile and inflation isn't that volatile. So it's not a good hedge for one another. What is a good hedge for inflation is actually stocks, because you think about the real return that companies are delivering. That is actually enough to overcome inflation over time. So if you're concerned about inflation, stocks do a perfectly good job of giving you real returns. Gold might have a place in your portfolio if you have a very specific use for it. But as a store of value, again, you have to think about how many other people are trying to store that value as well. And then as an inflation hedge, too volatile, I think, to be a good inflation hedge. Let's talk about private. Nick, you were saying that you get hit up all the time. So I'm going to do sort of a private equity and private credit is really what we hear a lot about nowadays. That's a very popular thing. I'm sure a lot of private credit wholesalers are contacting you all the time. I think there's sort of cycles in finance where we go through periods of time where we relearn the same lessons again and again and again. And I'm certain that we're destined to do that forever. And one of the things that's interesting about private credit is there's this idea that there's higher yields to be achieved, and people kind of ignore the risk aspect of that and just say, well, higher yields is good. Higher yields can be good, but you also are presumably taking on more risk. And with private credit, one of the risks that you have is diversification. Another risk that you have is liquidity. So when things are going well, if your asset doesn't have a lot of liquidity and there aren't redemptions and you don't need to do a lot of, trading, that's not a problem, right? And you're just reaping the higher yield over time. When things get rough, how is that asset going to perform? Because Nick, you said it before, right? You're pricing in, you have to expect there will be periods of time of volatility. The day is coming where we're going to have another bad year like 2022 for fixed income. Private credit will not be immune to that. But the question is, can you get your money out and at what price, right? Is there going to be a market there for that? And we've seen this before with bank loans, and we've seen this before with other financial instruments that get a lot of attention and people think they're getting yield for free. There is no such thing as yield for free. You are paying for that somehow. Maybe that's okay, but you need to understand the risks before you invest.
And Rob, just for our audience sake, can you give us a very high level kind of overview of what private credit kind of is? Because I think we understand, in terms of public credit, that's when you're investing in bonds that, trade on an exchange. What exactly is private credit? And even private equity, and the high overview of, those different types of ways that you can allocate capital, which seem to be becoming more accessible to the everyday investor.
Yep, absolutely. And that's true, by the way. The private space for equity and credit are moving into sort of trying to get into 401ks, for example, which is interesting because you're trying to take something illiquid and put it into something that vehicles that do a fair amount of retail trading.
Right.
But private equity and private credit are basically similar in the sense that there are regulations that are incurred when you go public. You need to have disclosures, you need to have certain standards that you're meeting. And private is really an interaction between two parties that don't require the same I'll call them guardrails that you have in public companies, which may or may not be good, right? You think about a small company that's starting up, maybe they don't want to IPO yet, maybe their financials aren't looking great, but there's some people who view them as having promise and are interested in investing them at various stages in the venture capital or private equity life cycle. And so they're early investors a lot of the times in private equity, right? And it doesn't mean that the company can't be mature. There are obviously mature companies who are still private over time. But a lot of the time, that's what it is the companies are starting up, not big enough really to go public. Maybe they don't even meet listing exchange requirements yet. And so private markets make sense for them. Private credit is really more of an interaction of a loan between two parties that doesn't get syndicated in the way that a normal fixed income interest rate would. So if a bank ends up, or an insurance company more likely now, ends up loaning a company money without having to put out a prospectus and without having to think about, 144A, designation, for example, then maybe there's a good way for them to figure out like sort of a way to avoid some of the costs of doing that. And again, it's not to say that those assets are necessarily more risky, but there's a reason that we have public market disclosures, and that's to understand what's happening with companies. And getting away from that might make sense in some instances, but it's really something where you got to look under the hood in a lot more detail. Let me talk about one more thing here. Do we have another minute? Because I know we're
Let's
almost
talk
out of
about
time here.
cryptos. I think that's something that's been on the forefront of a lot of our clients' minds, and obviously it's been making headlines, and Bitcoin crossed $100,000 a coin. So I mean, it's one of those things that I think people want to hear what your thoughts are.
Yeah, and I mean, it gets a lot of attention, and we talked about the election before, and Trump has his coin, and Melania has her coin, and they're already billions of dollars, which is wild. I think that's really an interesting environment to operate in. A lot of times with crypto, at least historically, you've seen them kind of be memes, and now they seem to be fundraising mechanisms, and all kinds of different things. I want to focus on Bitcoin because I think Bitcoin is probably the most established of the cryptos. And Bitcoin, there's a couple things that we hear about. One is that the technological advance that you see in the blockchain is sort of embodied in Bitcoin. And the blockchain is a digital ledger, which can have useful purposes, but isn't mutually exclusive to Bitcoin. So if you like the technology behind Bitcoin, just know that Bitcoin is not the only option to engage with the blockchain. And the blockchain, if it serves a use for companies and entities in the future, will be there. So it's not mutually exclusive to one another. But then with Bitcoin too, a lot of what's happened historically, or what people were talking about, is it's a storage of value, right? You put money in Bitcoin, and your money will presumably be there over time. That sounds a lot like gold to me. It sounds a lot like just another currency, like a fiat currency to me. And I think there are strong parallels between Bitcoin and a fiat currency, which kind of argue against the case for investing in it, which is when you invest in, let's say, I don't know, Swiss franc, for example, you expect to just hold the Swiss franc in the account, and you don't have to worry about whether or not it's going to be there tomorrow because there's an established system for protecting your assets. In theory, maybe that's what Bitcoin is doing, but we're not short on safe assets, right? You can find a bank account pretty easily. When you invest in a Swiss franc bank account, though, you're not getting anything for that. Like maybe you're getting a little bit of interest, but you're not investing in anything. And so you wouldn't expect a return from investing in Swiss francs because maybe it moves relative to the dollar, right? There's some speculation there. But when you invest in a company, there's underlying cash flows that you're capturing. They're doing something, right? They're creating goods and services, and they're making profits and passing that along to you. None of that is happening with Bitcoin. So the value of Bitcoin is largely speculating on what do other people think Bitcoin could be worth in the future or now. And anytime you engage in trades that are counting on other people anticipating what the value is, I think that's a dangerous game to play, right? How can you justify Bitcoin being where it's at? It's because other people are willing to pay $100,000, for a Bitcoin or whatever. So I think from our perspective, it really just runs counterintuitive to a lot of theory in finance, which is you invest in assets that have some risk, but generate cash flows. Bitcoin has risk. We've seen that with the volatility, the cash flows that you've seen or the yield that you get from Bitcoin often come through, frankly, not very regulated and very risky lending activities to other people with Bitcoin. You saw that with, FTC or FTX and Three Arrows and whatever. So a lot of risk associated with Bitcoin. I know it's done very well, so it's going to attract people's attention. I am not of the opinion that it belongs in a portfolio.
Thank you for that, for sharing that. Yeah, I think, that's at Mercer Partners for all of our clients that are joining us today. They'll know that, we don't have it in our client portfolios, and it just is, it's not a risk that I think is worth taking when you can get the returns that you need to have a successful financial plan, through, stocks and bonds. That tends to be our, our approach. So
completely agree. I mean, when you got 22% return in the U.S. equity market, if you're looking for more than that, I don't know. But yeah, I do agree with that.
Yeah. Well, is there any other questions? We've got our experts from Dimensional here today. Does anyone have any questions as we kind of turn the corner and round into the close here of our presentation? I've got one more question I can throw out. Do we have time, Chad? Are we still okay?
Yeah, let's do one more question. We'll wrap up.
Okay. One other question, Rob, that we get a lot, from clients, and this is honestly something that's been weighing on my mind, as an investment advisor, and what the potential implications can be long term. But, we get, the U.S. debt today, is what, $36 trillion and continuing to climb, every single day. It seems like it's, by all accounts, unsustainable. I mean, is this something that investors should be worried about, or, what's your view in terms of the sustainability of kind of where we stand from a debt perspective, as the U.S. and the potential implications on markets?
Yeah, it's a good question, and we do hear a lot about this, especially every time we hit the debt ceiling, which happens all the time.
Right.
It comes up in the news, and there's some consternation and a government shutdown, and then we kind of issue more debt and raise the ceiling and kick the can down the road a little bit. I think there's impacts, I think, for American consumers in particular, because what I think about when I think about the debt level is ultimately take that to an end state. How do you solve for that? It's the U.S. wouldn't default most likely in an emergency situation. If things got really bad, we would inflate our way out of it, right? Because you can print currency to meet debt obligations, but then doing so has a massive inflationary effect, which is why we're not doing it. And so this kind of comes back to, okay, if you're concerned about the debt, then maybe what you're really concerned about in an extreme scenario isn't default, but instead inflation. And we have a lot of data that we've collected from, other countries outside the U.S. because the U.S. hasn't, we've had inflationary environments, not quite what we've seen in extremes in other countries. And that can be damaging for the economy. But even when you think about the U.S., for example, in, the 70s, where you had inflation that was, pretty rampant, the economy is still able to move forward. So I think it's one of those things where what can we do to address it in the future is there's lots of different options on how to achieve that. And there, by all means, isn't a particular measure where we're saying, if this limit gets crossed, it's all over, right? There's not like a cliff that you all of a sudden fall off. And we've actually seen some of that with the rating agency changes, haven't we? Where U.S. debt, and that was more from, the willingness to meet the debt obligations as opposed to the ability, but so maybe somewhat intertwined, where you have rating agencies saying, I don't know, is the U.S. really top tier credit anymore? That has an impact on American consumers, doesn't it? Because we have to pay the interest on that through the form of taxes. So impactful for U.S. consumers. Ultimately, when you think about inflation being the solve, if you will, which isn't a great solution, but a solution for, high levels of debt, there can still be, good market returns to have in high inflationary environments. If it becomes extreme, obviously, Zimbabwe, that's not great, but yeah, hopefully we're a long way away from that. We can take some lessons from other countries and what we don't want to do, but there's still time. So I'm hopeful.
Good, thank you for that. So one more question here. We got it from Rick. Thank you for your questions, Rick. So what do you think, Rob, if the US returned to the gold standard, how would that impact the market? So obviously right now the US dollar is the reserve currency around the world. If that were to change, and correct me if I'm wrong, but did the Trump administration, they didn't propose that, did they? Is that something that I don't think there might have been rumblings about that, but
kind of hard to follow, to be honest, with the Trump administration, because there might have been a tweet that I missed. But from like, we have been talking about this for a while, like the return to the gold standard. And I'll even kind of broaden this out a little bit and say, what if instead of what if the dollar doesn't become the dominant currency in the world, like for trade? That's always a big concern, right? What if we lose our pole position?
Right.
I think it's helpful to look in the perspective of how much international trade happens in dollars and how has that changed over time. And I'm trying to recall, because I think that the last time I looked at this was sometime last year, it was something like 92% of like global trade happens at least on one leg of the currency against the dollar. Like, it is an enormous amount that's focused on the dollar, and that hasn't changed that much over time. Because when you think about it, what are your alternatives for different currencies that you would use? So there's Europe, which has a tremendous amount of problems, right? We're not even sure if the euro is going to be around anymore. There's always people who are threatening to leave, or are there new joiners coming in? And can the central bank actually coordinate in a way that is effective across all the markets that are impacted? China is another one that gets brought up all the time. I don't think people totally understand that when you, like, Chinese currency isn't something that you can just buy and sell offshore. There's not an ability to do that. It's onshore only for Chinese currency. So if you actually can't use it to settle international transactions, and that's on purpose by the Chinese government to help regulate the value of their currency and stop other people from speculating on it. So if you kind of rule out major economies throughout the world, like Europe and China, where are people going to go? Like right now, the dollar is king, and I can't really see that changing. I mean, maybe it slowly changes over time, but the idea that it's going to get unseated by a competitor, I think, is unlikely. And frankly, the same thing with gold, right? When you think about the gold standard, what are you trying to achieve by moving to a gold standard, instead of dollar back? Like, maybe there are countries out there that really don't like using the dollar, like Russia, for example, doesn't like that there's global trade in dollar, because that helps, we can help regulate some of the sanctions that are on them, for example. Aside from that, there's just not that much reason to move. And by the way, you do hear about this at a recent BRICS summit, which is an acronym we don't end up using that much anymore. But at a recent BRICS summit, Brazil, Russia, India, China, there was a lot of talk, especially by Russia, about, hey, let's do something else other than the dollar. And nobody's picking up that baton right now. So I think that's kind of telling of the fact that there's, the dollar may have issues, and Nick, you pointed out the debt as well for the country, and that's problematic. And some people will say that we abuse sort of our foreign policy, I guess, in terms of the dollar strength and usefulness. There's just not an alternative right now. There's not a real alternative right now. So
yeah, I think we agree on that. So we're getting close to the top of the hour. So I think we want to wrap things up. Rob, Dustin, thank you so much for joining us today. We truly appreciate the partnership with Dimensional, and look forward to continuing our strong partnership. And I'm going to turn things over to Chad to wrap us up.
Thank you all.
Yeah, like Nick said, thanks to our partners at DFA, Dustin, Rob, really appreciate your time and diving into a lot of different topics. We could probably go on another hour and a half getting into questions on, what's going on in the world today and markets in general. So appreciate your guys' time. Thank you everybody for sticking around as well. If you have questions that we were not able to address or following our time together this afternoon or tomorrow or whenever you've got a question that pops into your mind in regards to, your financial well-being in your portfolio, that's what we're here for. So please don't ever hesitate to send us an email, give us a call. If there's something on your mind, we want to help. So if anything comes to mind, certainly reach out, but I appreciate you all hanging around. Have a wonderful rest of your day, and we will all talk to you soon. Thank you, guys.
Take care, everybody.